Hi, I'm Mike Ruger. I'm the managing partner of Greenbush Financial Group, and today I've got with me my partner in the firm, Dave Wojeski. Dave is also the managing partner of the Wojeski and Company accounting firm, which is why we brought him in for this topic, because both of us have gotten a lot of questions about this Biden tax plan. So with the elections coming up, if Biden were to win the election, he's already shown us some of the pieces of the tax plan. And what we wanted to go through today was, what the tax rules are now versus some of the pieces of the Biden plan that could change going to 2021. Because think about it, if the elections are November 3rd and maybe we don't know the results for a few weeks, that's going to give business owners and individuals maybe a few weeks to make some of these moves. If Biden wins, if the potential that tax rates could go up starting in 2021. The first item we're going to talk about is the possible new treatment of long-term capital gains and qualified dividends. So for long-term cap gains, to give you some background, if you hold an investment for more than 12 months, you get that preferential tax treatment of, if you're in certain tax brackets, 15% Fed and maybe some state tax depending on where you live, versus ordinary income tax rates, which can be as high as 39%. And Biden has some things within his tax plan that could alter this. And Dave, could you kind of highlight some of the changes that he's looking at?
Yeah, I think there's no secret that there's a deficit problem both in the states and the federal side. So there's going to be pressure to raise taxes, and one of the areas that's politically easier to pass along is the capital gains tax, which has been reduced for quite a while now to 15% versus it's about a 22% spread between the highest tax rate and a 15% rate. If you're in the highest bracket, you're going to pay 20% capital gains. Biden's plan would be to raise the capital gains rate to basically the ordinary income rate at very high income taxpayers. So the question really becomes, before you get to the end of the year, does it make sense to accelerate some capital gains you may not have thought about accelerating before? So if Biden's plan were to increase capital gain rates for you personally by 10 to 15%, and let's say you had a $100,000 gain on Apple stock, you would have a additional tax of 10 to 15 grand on that capital gain. Does it make sense to take that capital gain during this year, knowing that you may take it at some point in the future, just to save the tax on the tax rate? And there's more. Obviously, there's more. You should never let the investments decisions be driven solely by tax, but it's certainly a factor into whether you're going to sell something or not. And a lot of it is just math from that standpoint. If the tax rate changes by 10 or 15%, how much of a change in a stock value can I absorb and still be at a break-even point from a tax perspective? But we're getting calls a lot now, as far as nobody ever called before for a while has said, I want to pay tax. That's essentially what they're saying now, is like it might make sense to pay tax sooner than it would have before.
Yeah, and that applies to both the investments, like real estate. So people have real estate, that's a little trickier because, people trying to list their house and sell it before the beginning of next year. But the other thing it could change is, so we have some clients that are employees of publicly traded companies that have ISOs. So these incentive stock options are, you exercise them, you hold them for 12 months, you get preferential tax treatment. If you're one of those ISO holders, that might, like Dave was talking about, incentivize you to maybe sell some of those ISOs that you bought and held. And for people that are still in that strategy, and then ISO 12 months goes into next year, it could be a coin flip depending on what your tax bracket is going, like where you could be taxed long-term cap gains or ordinary income going in. And it's going to change probably some investment strategies for people. Like I think municipal bonds will become more popular, because when you talk about qualified dividends, like if municipal bonds are tax-free, like that could be an incentive. Or if you have like a stock that's issuing dividends right now, if you were getting it as a qualified dividend, but now it's going to be taxed as ordinary income, it might incentivize people to hold different types of stock depending on whether it's paying a dividend.
Yeah, I'm sure. I mean, I'm sure it's going to change the investment strategy for sure.
Yeah.
Even from our standpoint, is working with the clients from that standpoint, is figuring out, what income makes the most sense for them. And the weird thing, I've gone through this before when the capital gains rates changed, is, even an installment sale right now, let's say you sell a building and you hold paper, you pay tax on that over time. You can elect out of the installment sale and say, hey, I want to pay all my tax now. And then as you receive the payments, it's all just principal at that point, and that can make sense. Again, if you're getting a 10 to 15% spread, and that's not a decision on sell, that's a decision on timing a tax. So you're not even deciding whether it makes sense to hold Apple for an extra couple of years to offset it. You're selling the building. You just have a decision as to when you want to pay the tax, and it's probably a no-brainer if it's not a significant amount, you can afford it to save the 10 or 15% and take the installment sale in this year and not report it as an installment sale.
Gotcha.
There's a lot of questions when the rates are being, really maneuvered like they are.
Yeah. The next item is ordinary income tax rate. So because the deficits for the government have gotten so large, there's really two ways that they deal with that historically. The one is to raise taxes, and the other one is to cut costs. And raising taxes seems like the more likely option going forward. So with that, if ordinary income tax rates go up as part of this plan, which ordinary income tax is anything you pay on your W-2 comp, pass-through income from an employer, so it's really those gradual rates that go higher over time. Dave, could you speak to some of the things that Biden's talking about within the ordinary income tax?
Yeah, there probably will be pressure. Intuitively, it makes sense to be pressure on ordinary income rates. So, weird thing is you now have to shift to a mindset of, okay, do I want to pay tax earlier than I would previously? Just like we talked about on the capital gains side is, do you want to pay tax on ordinary income before? And you have some control over it from a business perspective. You can bring income into a year earlier than you normally would, as opposed to normally trying to accelerate deductions. And with Biden's plan, which would raise the corporate rate right now is 21%. He would like to raise that to 28%. And when Trump lowered it to 21%, there was also this QBI deduction, qualified business income deduction, that was put in place for pass-through entities so that they'd have a level playing field tax-wise with the lower corporate rate. But if you're going to raise the corporate rate, it doesn't make sense that the QBI deduction would stay, and it certainly wouldn't stay at the same level it would now. So you're getting a deduction now that could possibly end at the end of this year, that if you want to take advantage of that, you actually would want to accelerate income to maximize the QBI deduction, which really is about a 7% tax savings at the highest bracket. So it's a pretty good deduction. So you get to the end of the year this year, you're going to look at it and say, hey, is this a year I want to bring income in?
Right.
Pay more tax, but likely at a lower rate than you would pay on the same tax the next year. And for a business owner, you're normally deferring tax or income a year. It's not like you're taking income from this year and you're going to wait for 10 years to pay it back. You're going to pay it the next year. Yeah. So I think that's another thing to look at with everything else you're looking at as far as income levels.
Yeah, and then we've also, for the pushing more income into this year on the individual side, we've also gotten some, should I be doing a Roth conversion, which is essentially, say, taking some of your pre-tax IRA assets or 401k assets, intentionally pushing them, paying tax, pushing it over to the Roth sides and realizing that income this year. That could make sense for people to make that conversion. And plus, with all the COVID stuff, we have a number of business owners whose income was lower anyways this year. So with kind of both together, saying income's a little bit lower, tax rates potentially being higher next year, that whole Roth conversion before 12/31 could make sense for
in some cases it's really a no-brainer, especially if someone were to have a net operating loss or a low income year.
Yeah.
But there's so many factors that go into the Roth conversion. I know we get questions all the time that, hey, rates are going up, I should convert all my income. But it's not that simple. It's the age of the participant, what's your future going to look like, who's going to inherit the money, what are your alternative investment options. It's really a difficult decision to look at. And there's some cases where it's, no, you're definitely not going to do it. And there's some cases where you're definitely going to do it. But the vast majority are, you really got to look at it and make a sound decision.
Right, yeah.
One of the other interesting areas to look at with Biden's plan is what the impact is in the retirement area. I know from our perspective when counseling our clients, there's three ways that you really look at to save taxes, especially for business owners, right? You're going to defer income, which we may not want to do now because tax rates are going to change. We want to accelerate expenses, which we may not want to do now because tax rates are going to change. And then what always works is deferring income because, to the extent you can get a tax deduction for putting money in your own retirement, and it makes sense for all the other things that go with that, which is employee morale and providing for your employees. But it is driven by a tax savings mentality, and we drive that all the time. Hey, what's the plan? Are we in the optimum plan for saving taxes for this business? And how is that going to work with the new plan? I know you know this stuff. I'm always going to you with this stuff. So This is probably your forte more than us, but I know we will drive the same thing, which is how can we maximize retirement?
Yeah, and it is, Biden's plan is going to potentially change some things a bit because the way it normally works in retirement plans is you make contributions to the plan, and if it's pre-tax, you get the deduction, and that deduction's worth whatever tax bracket you're in. If you're in a 20% tax bracket and you put pre-tax dollars in, you're getting a 20% break at the federal level. If you're at that 39% tax bracket, you're saving a lot more. You're getting that 39% break on the taxes. Where Biden's trying to really level the playing field, saying instead of you getting a deduction, now there's going to be this flat 26% credit on all pre-tax dollars. So what that does is it incentivizes people that are in a lower tax bracket. So if I'm in a 15% tax bracket and I make contributions, now I actually get a 26% credit for all those pre-tax contributions, but it works the other way for those taxpayers that are at 39. So if I'm at a 39% tax bracket and now I only get a 26% credit, I'm losing about 13%. So if I put $10,000 into my retirement account, now that roughly I pay tax on 13% of it because I only get a 26% credit. And then when I go to pull that money out of retirement, I'm paying at an ordinary income tax rate. So people are going to really have to look at like the tax strategy longer term to say, if I'm in 39 now, but I'm only going to be in 35 in retirement, 35 plus the 13 I paid on it, I mean, they could be in 48% tax bracket. Business owners for the first time might be incentivized to actually make Roth contributions to say, just say, I'll pay tax at 39% on it now, accumulate it completely tax free, and then when I take it out, it's all tax deferred. So it's like,
rarely do the business owners make Roth contributions now because generally the business owner is usually a little bit older.
Right.
So that the Roth doesn't usually make as much sense. But I'd be curious to see what that looks like when we lay some of those scenarios out.
Yeah, and the one blowback that people have to be careful of with these retirement plans is when we sit down with business owners, we kind of say, hey, if you put in $30,000 for the employees, you're going to get a tax benefit of $50,000, which is what incentivizes those business owners to sponsor the plan. But now, if these business owners have to rework the numbers and saying I'm getting a lot lower, we might go to them and say, hey, for you putting in 30, you're only getting a $20,000 benefit. So it's going to be curious to see if some of this stuff goes through, that if business owners back away and say, well, I'm not going to offer as much employer contribution because I'm just not getting the big incentive I was before. So they got to just be careful of these ancillary blowbacks that could come when they make these changes to the plans.
Right, yeah, it'll be interesting.
Yeah. So there are a number of other changes for individuals within the tax plan, and we're just going to kind of highlight some of those. So the one is they're going to make some changes to the child tax credit. And you want to highlight some of the changes there?
Yeah, I think the positive changes there are essentially increasing the amount of money related to the child tax credit you're getting for children. It's very age related, so younger kids are going to get a little bit of a credit up until older kids. It exists now, it's income limited, but these would be enhanced quite a bit. So they're all positive changes.
Yeah. And the other one they've got on the table is the first-time home buyer. So this was something that was back from the Bush administration. They're looking to bring it back again. And the number we've seen so far in the tax plan is a $15,000 potential credit for first-time home buyers, and that could influence people's decision. If they're a first-time home buyer and they're looking at a house like towards the end of this year versus the beginning of next year, it might say, hey, you might want to wait a few months to see what happens, because that could really work towards like the down payment of the house.
Yeah, definitely. It'll drive the housing market for sure. It did last time.
Yeah.
Not that it needs it right now.
Right.
Apparently.
Yeah. And the other issue we were just talking about was like that whole Medicaid situation with the long-term care issues and how expensive it is for everyone. They are including that tax incentive in there as well for caregivers to kind of encourage people to kind of caregive for their own family and friends and whatnot. Do you want to?
Yeah, I think you can see. I mean, tax, policy the tax code is used to drive policy. So you can see what the policy is. The policy on home buyers, incentivize home buyer people. It's obviously good for the economy, but it's also people that take a little bit more pride in their home when they own it, as opposed to being renting. And on the home care side, we're in New York State. The number one budget item in New York State is Medicare. Medicare is mostly funded by federal money. So the federal government, knowing that the states are going to be pushed for Medicaid dollars, are trying to say, hey, maybe if we incentivize people to stay at home with their elderly and care for themselves, we can reduce the reliance on the Medicaid system. New York passed yesterday. It started with their look-back period on the home care related to Medicaid benefits when caring for somebody at home from a Medicaid system perspective. So, there's going to be a squeeze on Medicaid for sure, and this is just one aspect of it. But yeah, that's a good benefit as well. There are some positives.
Okay. The last piece we're going to talk about is the changes that could impact estate planning. One of the big estate planning pieces that we've had up to this point is something called a step up in basis, which means if you have an asset that's appreciated over time and you're still holding it when you pass away, your beneficiaries get a step up in basis, which means when they sell that asset, it's the fair market value. Their cost basis is the fair market value on the day you passed away. They normally don't have to pay any tax on it, where this is maybe one of the bigger changes to the Biden tax plan for estate planning going forward. Can you talk about?
Yeah, the estate planning issue over the years has evolved because there was, when the threshold was very low, I remember when it was 108,000, your plan was basically to avoid the estate tax. Now the federal exemption is 11 million, and you can, with portability, which is a separate topic, but you could really pass away with a spouse with 22 million. Most people now are trying to get their assets included in their estate because they get the step up in basis concept. So if I bought a house in 1950 and they paid $40,000 for it with improvements, and I'm going to sell it for 300. If I don't get that step up in basis and my child inherits it and sells it for 300, they have a $260,000 gain.
Yeah.
That's just part of the problem. The other part of the problem is try to get your records for tax basis when you built a house in 1950. From a CPA's perspective, that's going to be a nightmare to deal with. But that's a really significant issue to that plan that is going to be very difficult to deal with because people have planned for that. The record keeping is going to be a nightmare, and it's a big tax benefit. The second piece related to that is just the fact that the estate tax, there's a rollback, a sunset to this under the Trump administration at 2025. So something's going to be done with that anyway. But if there's a reduction in the estate tax, everything you possibly may have done, you have to revisit again.
Right.
And then even, do you want to make gifts now? If you are a wealthy taxpayer and it's going to go to 5 million, do you want to get all because they will grandfather it, right? So it's not like if I give away 10 million now, they're going to say, hey, you gave away 5 million more than the 5 million exemption is going to be. So, between your CPA, your financial advisor, and your estate planning attorney, you really should visit the estate, especially probably before this happens, because you can make some assumptions before the end of the year, and probably there's some things you should be doing from an estate perspective to save estate tax, really no gift tax, but income tax as well.
Right.
And these changes are likely imminent.
And the other thing it could incentivize big time is the life insurance side. Because before it didn't matter, like life insurance, beneficiaries get it tax-free, where step up in basis, you get it tax-free, where now, without the step up, you could say, well, if I really want to leave like easy assets to pass, it could really incentivize people to go kind of that, permanent insurance aspect for like the wealth building and passing on to the next generation.
Yeah, I think that part of the plan, the step up, I hope that they wouldn't include that if they're going to make changes. They would just lower the exemption because it's just a burden on the taxpayer to try to figure out what their business is.
Right.
You can inherit assets for generations.
Right,
So.
All right, well, thanks, guys. We just want to kind of touch on those points, but if you have any questions as it pertains to your business, your individual tax situation or financial situation, please feel free to reach out to us at moneysmartboard.com. Thank you.